which can't be overrated for any economic sector. It offers a high quality of living, excellent connectivity, and an inspiring and convenient environment for business. Frankfurt's application for the ISSB had been broadly supported by the State of Hesse, the federal government of Germany, the European Commission, the European Parliament, and the European Central Bank. I also, once again, want to thank all the 180 supporters from the fields of industry, finance, science, and civil society for their outstanding commitment to our common goal to bringing the ISSB to Frankfurt. The success story of ISSB is a perfect reference to Frankfurt striving for attracting the future AMLA, the Anti-Money Laundering Authority. The EU member states have agreed to implement the Anti-Money Laundering Resolution. The call for proposals for the headquarters of AMLA is expected for the next presidency of the Council of the European Union, which will be conducted by Sweden. With gaining ISSB as a further important financial institution, Frankfurt has a strong position as a financial center and will keep on striving for the AMLA. Now I guess you are keen on hearing the views of our prominent hosts and speakers. Thank you very much for your attention and have a successful event today. Thank you very much.
Thank you very much to Deputy Mayor Wüst. And it is now a great honor to hand over to the chairman of this year's European Banking Congress and Chief Executive Officer of Deutsche Bank, Christian Sewing. Wonderful to see you again. The floor is yours.
President Lagarde, Deputy Mayor Wüst, ladies and gentlemen, I also would like to extend a warm welcome to you here at the Alto Oper in Frankfurt on behalf of Deutsche Bank and our three co-hosts, BNP Paribas, Commerzbank and HSBC. It is an honor for me to open the European Banking Congress. As we just heard, this year marks the 32nd edition of the EBC, and there have been several congresses which happened at times when the world economy was in upheaval. But I think few of us have experienced a situation like the one we are now in. A situation where so many major challenges are colliding and decades-old certainties melt away from one day to the other. The terrible war in Ukraine, with all its human and economic implications, the global spike in inflation, which is threatening economic prospects, but also social cohesion, the significant disruptions in supply chains and trade flows, these are all shifts that we need to manage collectively here in the room, but also outside this room. And that's why the title of this year's Congress, Coping with Transformational Change, is so apt. Yet, transformational change entails more than solutions to the current crisis. It actually calls for new foundations for European future economic success and our prosperity in the long term. It is about ensuring Europe's long-term competitiveness and its leading role in the global economic order. And that means halting the downward trend we are currently on is one task. Over the past 20 years, the EU shares of global GDP has fallen by a quarter in purchasing power parity terms. It now stands at around 15%, behind the US at 16% and China at just under 19%. If you ask international observers, many of them associate Europe with slow decision-making, rather weak innovation, an agonizing fragmentation of interests and positions, and also some over-regulation. Kind of an old continent going gray, that is the stereotype. Add to this the over-reliance and dependencies on individual counterparts, which is most obvious in the case of Russian oil and gas supplies, but it also applies to several other fields, from future critical raw materials and semiconductors to defense. There is some hope that Europe could once more succeed in using a crisis as the basis for tackling crucial reforms, following what Jean Monnet wrote in his memoirs in 1976. Europe will be forged in crisis and will be the sum of the solutions adopted. Ladies and gentlemen, nothing could be further away from my mind than to contradict this great European thought leader. But I'm convinced that today, almost 5 decades after Monnet made his statement, we do need a different approach to prove the stereotypes about Europe wrong. We need to shift focus from saving Europe to building Europe. We have been talking about the concept of strategic autonomy for several years. Now it's time to take it really serious. And that means that we Europeans must stop reacting and start developing strategic plans on how to make Europe fit for the future. It's nothing else that we need an Agenda 2030 for Europe. And the very first step must be that we finally create a real European home market. Wherever I go and whoever I talk to from non-European countries, actually almost nobody understands why we don't finally go for it. A common market with 450 million people and consumers, not split in 27 different jurisdictions. By the way, this also means that we have to rework things like European antitrust law. And given the world we find ourselves in, a European agenda cannot ignore the issue of the second point, and this is defense. The illusion of everlasting peace has been abruptly shattered this year, and at the same time it is obvious the US is no longer prepared to bear the burden for European security to the same extent as in the past. The consequence is that Europe needs to take its own defense more seriously, and in recent months, EU countries have rightly already taken some steps to strengthen their capabilities in this field. But much more needs to be done, and pan-European thinking is, in my view, required. No less urgent is that we put our energy supply in Europe on an independent footing. This involves new supply contracts and a broader diversification of suppliers, a determined European-wide expansion of renewable energies. And let's not only envision 100% energy supply. What we really need to do is we must focus on sourcing even more energy than needed, as only then, over time, prices will become again competitive. At the same time, Europe must raise its profile in sectors that will play a key role in the future. And sustainability is a prime example here. We really do have a competitive edge in this area. And it's such a great opportunity to set the pace globally in one of the most important fields of the future. Other nations and continents admire us for this lead in technology and expertise. And that's why we must work at all levels to defend it, technologically, in terms of financing, but also when it comes to political support and regulation. And next to sustainability, we must also focus on technology more broadly. Other key future fields with potential include innovative mobility solutions, fifth-generation mobile networks, artificial intelligence, and quantum computing. Market shares are not yet completely distributed, and Europe would do well to join forces. Ladies and gentlemen, all of this needs investment, though, which leads to an area which is far too often overlooked, and hence I'm so happy to host the conference today. And this is that we need to talk about European strategic autonomy and financial autonomy. It is concerning that this key cornerstone is simply left out of the debate, just as if the financing of the upcoming transformation were a side issue. But for this transformation, the financing piece is nothing else than the heart and the lungs. The sums that will have to be spent on a successful transformation in the coming decades are enormous, and Europe lacks the capital and financing structure to master exactly this piece. We urgently need to change course if we do not want to rely primarily on foreign banks to finance Europe's future. And nobody should take this danger lightly. Losing financial sovereignty for Europe would be just as bad as the energy dependence that is causing us so much pain right now. To avoid this, two things are required. Number one is a political determination to create the conditions that attract private capital to a much greater extent in Europe. Without a substantial increase in private sector investments, Europe cannot be competitive over long term. We will neither master sustainable transformation nor be able to keep pace technological. And that is why it is so important to finally push ahead with the Capital Markets Union in order to create a liquid and attractive market for domestic and foreign investors. In my view, the Capital Markets Union is the central pillar of Europe's future viability. Without it, and I said it before, the European Green Deal will be impossible to finish. Unfortunately, given the lack of political will or unity in the EU, it will take many years to complete the Capital Markets Union, even in the best-case scenario. But we shouldn't give up. We should therefore readjust priorities and now focus on measures that can work quickly and help in the interim, such as facilitating securitizations. Compared to the US, the European market for securitizations is tiny, just 1/10 the size of the US market. And the reason is outdated and restrictive regulation in Europe, and that needs to change. We can no longer afford to leave financing sources with such potential lying idle. And number two is a more supportive environment for banks in Europe. European strategic autonomy is impossible without strong banks that can support its economy at full strength in all situations. We have been part of the solution together with the right action taken by the ECB and the governments in the COVID crisis, and we want to be part of the solution going forward. In order to achieve this, we banks must first look at ourselves. There are always things we can do better, but I do see very committed and ambitious management teams across the sector. Admittedly, our industry has done well in recent years in a difficult environment, has achieved a level of stability and profitability that few had thought possible. Nonetheless, the gap between us, and in particular our US competitors, has not tightened. We must therefore not rest on our achievements, but continue to work on ourselves to become even more efficient, get even closer to our clients, and spend up significantly with regards to technology and innovation. There is no doubt. But at the same time, it becomes even clearer that the current regulatory framework does little to strengthen European banks. And German Finance Minister Christian Lindner, who I understand unfortunately had to cancel his participation at today's EBC on very short notice, recently affirmed this with remarkable frankness. The minister said banking regulation had focused too much on stability and consumer protection and too little on competitiveness and profits. And while he linked, rightly so, this with clear demands on us banks to do more for profitability, yes, it felt good to hear these words from him. Now we need to move forward from words to action and recalibrate regulation in Europe. 15 years after the global financial crisis, it is time also for regulators to acknowledge the positive developments we have seen. And that ultimately means that instead of further expanding and tightening, we should also look at where it might have gone too far. Banks must stay stable and resilient. And we do everything to do this in future. But next to stability, we also have a clear task to finance the economy and help to grow. And let me be clear, I'm not talking here about the way bank supervisors in Europe do their job. It is my fundamental conviction, and it remains my conviction, that our industry would have made less progress in recent years without the stronger supervision and the regulatory changes implemented since the financial crisis. The issue that concerns me is that the pendulum is about to swing too far due to regulatory and political decisions that structurally disadvantage our industry in global competition and limit our ability to support our clients and the economy as a whole. Allow me in this regard to go into a little bit more details on 4 items just as a representative. Number 1 is the regulation of European clearing business after Brexit. We fully support the need for the EU to strengthen this market. This, however, should not come at the cost of cutting European banks off from the global markets or by imposing punitive capital requirements. Many of our clients will still want to clear outside of the EU, and ultimately it remains their choice on where to clear. The only result will be that EU banks lose out on a field that is essential for creating a deeper and more liquid European capital market. One area of business where we already face significant hurdles is leveraged finance. Punitive buffers imposed make it more difficult for domestic banks to compete in this business, which is a legitimate segment that will play an important role, in particular in these days. And in particular, when it comes to the financing, the large group of medium-sized companies that form the backbone of our economies. And this underlines how Europe still tends to treat financial sponsors as something distasteful. But when we look at the US, a lively venture capital market, but also private equity industry is part of an ecosystem which is much more effective in supporting innovation and growth than we have in Europe. It should be our aim to make best use of these sources of capital for our economies, not to sideline them. My third point concerns the adoption of Basel III framework in Europe. The recent postponement is welcome, as are the suggested transition periods and latest adjustments which acknowledge the conditions of the European banking market and the European economy to a certain extent. But ladies and gentlemen, this does not take the long-term uncertainties off the table. The current plans would still impose considerable additional burdens on Europe's banks. According to a recent study from the EBA, for the largest banks, capital requirements would increase by up to a quarter. And when we talk about the impact of the broader economy, the planned stricter capital requirements for loans to companies without external ratings are real concerns. That means that 80% of all European companies would be penalized with higher financing costs or pushed into ratings where are neither economically or sensible for the vast majority. My last point is about financing the green transformation of our economy, which personally is so close to my heart. Sustainable finance has become a key sector for banks, and yes, we in Europe are leaders in this field. However, I fear that we will soon lose this leadership if we follow the regulation discussion and regulation continue as it has. Companies and banks are busy implementing different and overlapping regulations in Europe at the same time, and new ones are coming in from all sides. What is now needed is a consistent and balanced approach which gives companies the flexibility to implement the various frameworks step by step and actually work on the sustainable transition. Ladies and gentlemen, let me conclude. We are living in times of significant uncertainties with many developments that are beyond our daily control. It is all the more important that we set the right course for those aspects which we can influence and make courageous decisions on those which we can control. Where Europe is headed is among the things we can control. So let's finally move forward more boldly and make the decision that strengthen us in Europe and enable us to seize the future. European integration is the backbone of this plan. For me personally, Europe is a matter so close to our overall economy, but also to the German economy, and it is a matter of reason. I'm firmly convinced that we in Europe will only be able to maintain our prosperity if we press ahead with unifying our continent. Today, we have so much financial and policy-making intelligence from all over Europe in this room, and we can look forward to great presentations and fruitful panel discussions. So let's make most of this day, learn from each other, and together make a small contribution to help and shape the future of the European banking industry and ensure that we best support the growth of our economy while staying resilient. Let's also permanently renew ourselves and see where we can improve. The attitude of keep working to get better is so important, in particular in a people's business like banking is. We want to be part of the solution. Let us all together create the conditions so that we can actually do this. And while strengthening Europe's financial sector is crucial for the medium and long-term success of our economies, a major short-term priority is, of course, getting inflation under control. And that leads me to an institution which is at the heart and center of both of these challenges. And our first speaker, who I would like to invite to the stage now, is the person who, in her 4th year in her current role, has the most difficult, but also the most important role in European finance. President Lagarde, it is certainly no exaggeration to say that the whole world is following every step you and your colleagues at the ECB are now taking to fight inflation in the Eurozone. And I would like to congratulate you and your teams on the way you have managed to turn around monetary policy, for the determination and also at the same time for the clarity with which you have communicated to the market, and not least for the way you have captured the various currents within the ECB, at least to the extent that the ECB Governing Council speaks to the outside with clearly one voice. President Lagarde, I can assure you, everybody in this room wishes you the greatest possible success in your task. So thank you very much, and thank you for being our guest today. Thank you.
Dear Mr. Siving, cher Christian, dear Mr. Trichet, cher Jean-Claude, dear Mrs. Wust, dear Mr. Scholz, and to all of you ladies and gentlemen, good morning. Thank you to the EBC for bringing us back together. I'm sure you've heard that many times, how much more pleasant it is to be together. I'll share with you a comment that I heard a couple of days ago in a similar circumstance, where, just like with us at the EBC, thank you for inviting me, we had not met physically for 3 years. And that person very kindly looked at me and said, "You are older, but you look better." So I turn it over to you. We are all a bit older, but we are looking a lot better than on those awful screens. So it is my pleasure to speak to you this morning, and I want to thank you very much, Christian, for this kind introduction and for the very clear speech that you delivered with multiple messages that I'm sure many of us will, in the course of the day, continue to develop. But it is really a pleasure to be here. When the former British Prime Minister Harold Macmillan was asked what the greatest challenge was for a statesman. He's known to have said, "Events, dear boys, events." And indeed, as policymakers, we are constantly faced with unpredictable events and shocks. But what makes the situation we face today especially challenging is that we are not just facing a sequence of incredible shocks, ill-fated events, I would call them. The pandemic, the energy crisis, Russia's unjustifiable invasion of Ukraine. Thank you, Madam Deputy Mayor, for your words on that topic. And of course, high inflation. But as a result of that, the environment that we are operating in is changing profoundly. Some of the major trends that characterize the past few decades are shifting or even reversing. In particular, we can no longer assume, at least in the near future, that global supply will gradually expand or that global demand will act as a shock absorber. And this has implications for the focus of macroeconomic policy in the years to come. Today, what I will try to do is argue that three themes will matter. One, ensuring price stability as the different shocks play out. Two, lifting constraints on growth in the areas where they have emerged. And three, safeguarding a resilient financial sector which can support the transitions we will face. I will spend a bit more time on the first of these three items, as you can imagine, because for the ECB, displaying our commitment to our mandate is vital to ensure that inflation expectations remain anchored while inflation is high. We are committed to bringing inflation back down to our medium-term target, and we will take all the necessary measures to do that, rest assured. But in order to overcome the ongoing challenges, other public and private players will need to help accelerate the transition to that greener, more digital, more productive economy that we all aspire to. So let's have a quick look at the changing environment, which has been alluded to by Madam Deputy Mayor and by Christian Sewing. But I'll focus on a couple of them, which matter for us. One, probably of the most important macroeconomic stories of the past 30 years, has been the rising interconnectedness of the global economy and its implications for global supply and global demand. China's entry in the global economy, particularly as of its joining the WTO, led to a massive increase in global labor supply. Global supply chains became more unbundled and efficient, lowering inventory levels and reducing costs. And energy markets changed fundamentally as well as new producers emerged, notably shale oil and gas, particularly in the United States, making global oil and gas supply significantly more elastic. At the same time, globalization allowed growth to become less beholden to swings in domestic demand, as countries could rotate demand towards the rest of the world when faced with domestic slumps. This proved especially valuable in Europe in the wake of the sovereign debt crisis. Between 2010 and 2014, external demand as a share of euro area GDP more than doubled. When it was tough at home, we looked elsewhere, and it worked. These two forces meant that inflation became unusually low and stable. A floor under demand meant that major busts in domestic demand resulted in less volatile inflation. And elastic supply meant that major booms, such as the one we saw before the Great Financial Crisis, did not produce serious inflationary pressures. Now we are facing a new environment. New supply constraints have arisen in the global economy owing to supply chain disruptions, zero COVID policies, still surviving in some corners, energy production cuts, and the unacceptable Russia's invasion of Ukraine. And in this context, swings in demand caused by the closing and reopening of the economy have hit a wall. Rather than quantities increasing to match demand, as we had seen before, prices have surged instead. And that is a key reason why, alongside rising energy prices, inflation has returned so fiercely. We know that some of these constraints will fade over time. We are already beginning to see, for example, shipping costs declining, delivery times shortening. But other changes may well be more persistent. The shocks triggered by the pandemic and the war are creating what I have called a new global map of economic relationships. And in this environment, it is uncertain whether a seamless expansion of supply will continue and how global demand will be affected. And I would like to focus on two shifts that are characteristics of this new global map. There are others, but I want to focus on these two. The first one is what I call from efficiency to security of global supply chain, and the second is from dependence to diversification, and it will not surprise that I would focus on energy. From efficiency to security. This is reflected in the new industrial policy that in the very recent years have prioritized geopolitical goals over efficiency constraints. Many advanced economies are coming to see their past deindustrialization as vulnerability, leading to a push to reshore, close shore, friendshore, however you name it, those industries that are regarded as strategic. And the definition of strategic has had multiple dimensions, as we can remember from the COVID crisis. This is likely to increase cost and affect production while supply chains are adjusting. At the same time, this shift could cast doubt on China's role as a source of global demand, depressing investment and equity values for European firms. If you look at the recent policy choices in China, choices to focus more on domestic demand, coupled with the US export controls on semiconductors in particular, but not only, and trade restrictions on key technologies owing to cyber risks, this could definitely affect China's place in the global economy. The second shift that I want to also mention is this move from dependency to diversification, notably in the field of energy. Europe is experiencing painfully the cost of overdependence on a single supplier, an unreliable one. And the process of diversifying our energy supply will have ramifications for years to come. For instance, we may have to pay a premium for some time to attract uncontracted liquefied natural gas to replace Russian gas. In the longer term, the need to diversify is also likely to accelerate the green transition in Europe, and massive investment in renewables will boost both energy supply and aggregate demand over time. But during the transition phase, we face uncertain effects on both sides of the economy. We could see lower investment in oil and gas production, putting upward pressure on fossil fuel prices, while demand for those fuel products still remains high. That's the principle of the transition. At the same time, writing off existing carbon-intensive capital might produce a negative effect on wealth and lower aggregate demand. So as a result, all of the main forces that drove expanding supply over the past decades and cushioned global demand, the role of China, supply chains, abundant and cheap energy, are changing. And the net effect on aggregate supply and aggregate demand will only become clear in time. In this context, the three themes that I have mentioned at the opening of my remarks are crucial if they are developed consistently and together. First one, ensuring price stability as the different shocks play out. Second, lifting constraints on growth in the areas where they have emerged. And three, safeguarding the resilient financial sector which can support the transition we will face. I have to tell you, each of these three themes would warrant an extra speech. So you'll re-invite me. Maybe I could replace Christian. No, sorry. I didn't mean to say that. So let me focus on the first one, which is ensuring price stability. For monetary policy, this changing environment creates considerable challenges. You've mentioned that very kindly. I was attending a wonderful dinner last night, and most people I spoke to said, we really don't want to be in your shoes. It gives a measure of the challenge that we are facing. When nobody wants to take your job, there's something. Inflation in the euro area is far too high. It has reached double digits in October for the first time since the start of the monetary union. And with inflation likely to remain high for an extended period, we need to monitor the evolution of inflation expectations very carefully. Additionally, although recent data on GDP growth have surprised on the upside, yes, yet the risk of recession has increased. But historical experience suggests that a recession is unlikely to bring down inflation significantly, at least in the short run. So in this setting, displaying commitment to our mandate is vital to ensure that inflation expectations remain anchored and that second-round effects do not take hold. And that is why we have been raising rates at the fastest pace ever, by already 200 basis points in our last 3 policy meetings. These rate increases help us to withdraw support for demand more quickly. And they send a clear signal to the public of our determination to bring down inflation, which will help anchor expectations. Yes, we expect to raise rates further. And withdrawing accommodation may not be enough. Ultimately, we will raise rates to levels that bring inflation back down to our medium-term target in a timely manner. As I explained recently, how far we need to go, how fast, will be determined by the inflation outlook. This is forward-looking and incorporates all the different forces that we are facing: the outlook for the economy, the persistence of the shocks, the reaction of wages and inflation expectations, as well as the proper transmission of our policy stance. Interest rates are and will remain the main tool for adjusting our policy stance. But we also need to normalize our other policy tools and so reinforce the impulse from our rate policy. And that is why we recently decided to amend the terms and conditions of our targeted longer-term refinancing operations. The targeted longer-term refinancing operations addressed the need for significant stimulus during the pandemic, strengthening the transmission of rates to the economy via banks. But now the environment has completely changed, and we need to ensure that the lower cost of funding that TLTRO created for banks does not impede monetary transmission when policy normalization is required. Similarly, large-scale asset purchases were necessary to expand the policy stance when interest rates were close to the lower bound. But in the current environment, and acknowledging that interest rates remain the most effective tool for shaping our policy stance, it is appropriate that the balance sheet of the central bank is normalized in a measured and predictable way. In December, we will lay out the key principles in sufficient details for reducing the bond holdings in our asset purchase program portfolio. In parallel, our tools for preserving the orderly transmission of our monetary policy, notably the flexible reinvestment of the pandemic emergency purchase program and the new transmission protection instrument, will remain in place and available. Turning now to the lifting work that needs to be done. Monetary policy will ensure a timely return of inflation to our medium-term target, but the economic outlook will also depend on the alignment between monetary policy actors and other actors. In the short term, the stance of fiscal policy is important. And in this current environment of high inflation, fiscal policy needs to be temporary, targeted, and tailored. That's my triple T for you. It should be temporary so that it does not push up demand too much over the medium term. It needs to be targeted so that the size of the fiscal impulse is limited and benefits focused on those who need it most. And it should be tailored so that it does not suppress the price signal that is needed in order to reduce our energy consumption. Looking further ahead, while monetary policy can steer demand, it cannot remove existing constraints on economic growth. Other policy areas will need to act. Removing those constraints will not only rebuild supply that has been impaired by the recent shocks, it will also over time strengthen domestic demand in a world where external demand is becoming less predictable. A drive to speed up three key transitions will determine our future. First, towards cleaner energy. Second, greater economic security. And third, a more digital and productive economy. First, we urgently need to step up investment in clean energy to counterbalance lower investment in fossil fuels and falling Russian supply. And I would suggest, by the way, that some European countries are reasonably well positioned in that respect. But we need to beef up our games. This is not only about increasing domestic energy production, but also about innovation, about developing new technologies that will help us solve the intermittency and storage challenges of renewable energies. And in the short term, reforming Europe's energy markets will be critical and is urgent so as to avoid recurring volatility in energy prices while we diversify away from Russian gas. Second, I agree with you. Europe's strategic autonomy agenda will be pivotal in making growth more resilient to the changing nature of globalization. In a world fragmenting into blocks, it will allow us to retain access to critical technologies and resources, both through reshoring strategic industries and securing strategic alliances that are well selected and of which costs and benefits are weighted. And that will in turn underpin our energy transition, which is highly resource intensive. Let's take the example of the electric vehicle, which are just growing significantly at the moment. They use around 6 times more minerals than conventional cars. Now, some of them we have, many of them we don't. Hence the importance of operating strategically and selecting our alliances with that purpose. Third, to cope with shrinking global labor supply, as well, unfortunately, as our own aging societies, we will have to produce more with less. That is, addressing Europe's chronically low productivity growth by boosting our rate of innovation. This will require the rapid digitalization of the economy in terms of skills and technologies. Consider that only around half of EU firms innovated or adopted new technologies in 2021, compared with close to 2/3 in the United States. And yes, the Capital Market Union is one way to address those issues, because to innovate, you clearly need financing and multiple sources of it. Collectively, these transitions will require significant investment. The European Commission has estimated that climate-related investment needs alone will amount to almost €500 billion on average per year until 2030. And more than 100 billion per year will be needed to close the digital gap and upskill labor forces and manage the digital transition. So, let's not forget, this was a few months ago, but it is still there and being used and drawn upon. The €750 billion Next Generation EU Fund, with its focus on green and digital spending, is a good tool for ensuring that investment flows where it is needed over the next few years. But it will ultimately need to be matched and exceeded by higher investment from other sources. Obviously from the private sector, but also most likely by national governments that will play a different role. According to one estimate, the public sector will need to fund between 1/4 and 1/5 of climate-related investment. This means that when the time comes for national government to consolidate their fiscal policies, because that time will come after the Triple T, it will make a difference whether they do so by reducing transfers and public consumption and raising taxes, or by cutting public investment. If they opt for the latter method, cutting investment, as they did after the great financial crisis, there is a risk that supply will not be rebuilt and constraint of growth will continue to bind. And I'll come to my third and final theme, which you have described broadly and which I will just brush upon. Because to support all these transitions, we need a resilient financial sector. As you've indicated, the situation for banks has changed dramatically since the great financial crisis. You were there, I was there. I was finance minister for France at the time. And we all saw or lived through those dramas. Banks were indeed part of the problem. During the pandemic, which was an unparalleled crisis, the banks were at the heart of the solution. Not least because thanks to more solid and more rigorous regulation, they had stronger capital and liquidity positions. Now, we need banks that continue being part of the solution. So undermining the solid foundation we have built together, it has taken a while, let's face it, we are there, would not help bring this about. We are facing a fast-changing world, characterized by multiple shocks and profound uncertainty. And in this setting, over-diluting regulation would leave banks more exposed to shocks and less able to support the transitions on which our future growth will depend. And that would neither be in the interest of the sector, which ultimately would be less profitable, nor of the economy, which would lack the financing it needs and would find alternative sources. Because the nature of financial intermediation is changing, and we must ensure that this contributes to the sector resilience, that it doesn't threaten the sector resilience. So let me mention two changes that we see and where somehow we can be effective. The first one is the digitalization of payments, which is spreading rapidly, not in all countries of Europe, but certainly in a large number of them. That can create opportunities, and I know that some of you are seizing on those opportunities. But it could also pose new types of risks as new players, quite novice in the business, and new products, sometimes uncertain, enter the market. Central banks are responding by advancing the development of central bank digital currencies. These currencies could give banks a tool to offer improved products and services built on the stable foundations of digital public money. Banks will have a role to play in that digital transformation and can seize it. Not to cope with transformation, as is the theme of the day, but to thrive on those transformations. Second, the role of non-bank finance is growing and is a worry, let's face it, not just here in Europe, on both sides of the Atlantic. Its share of overall credit has been rising from 15% in 2009 to 26% nowadays. Now, this has to be reflected, if only for level playing field reasons, and security and protection, in a stronger macroprudential framework for non-banks. Specifically, we need a framework that focuses on building resilience ex ante rather than relying on ex post measures. There are many other things that I could debate and discuss for you, but my time is counted, so I will conclude at this point. We are indeed entering a new environment where the forces that created a sustained expansion of global supply and allowed global demand to act as a shock absorber are changing in front of our eyes, and probably profoundly. The effects of this shift are uncertain, but the duty of monetary policy is not. The ECB will ensure that a phase of high inflation does not feed into inflation expectations, allowing too high inflation to become entrenched. We have acted decisively, raising rates by 200 basis points, and we expect to raise rates further to the levels needed to ensure that inflation returns to our 2% medium-term target in a timely manner. But if we want to rebuild our supply capacity and strengthen domestic sources of growth, other policy areas need to refocus. Most importantly, they need to direct investment towards the transitions that will define our future, and the financial sector needs to be able to actively support these transitions. We have joint interest. Consistency between public policy areas remains important in a post-pandemic world. If we respond separately to today's challenges, we risk standing in each other's way. But if we act together, we can rise to those challenges and ensure that our objectives are met and that we seize the opportunity rather than lament about the risks. So maybe for another theme of the EBC for another year, you could change coping with thriving, because we can do it. Thank you.
Thank you so much to President Lagarde, and we would have loved to invite you to deliver an epilogue at the end of the day, but unfortunately Christian Lindner's slot is no longer available because his state secretary with responsibility for international and EU financial policy will be joining us later on. That's also a message to our audience, just so you don't rebook trains and flights. We will, in fact, be hearing from the finance ministry later today. Christine Lagarde has given us so many important messages. We will take them with us into all of our panels today, beginning, first of all, with our chairman's panel.
With inflation persisting, markets wobbling, energy prices surging, and inflation soaring, are banks stable and resilient enough to support a real economy under pressure? Looking beyond the short term, how can banks help foster a green transition whose urgency has only been underlined by the economic impact of Russia's war against Ukraine? What will unlock much-needed capital for green investments? Is it time to rethink ESG to catalyze truly transformational change?
And those are the topics